All right, good morning. Let's go ahead and get started. I'm Rachel Flum, the Executive Director of the Economic Progress Institute, and I'm here along with Doug Hall, who's our Director of Economic and Fiscal Policy, who will be doing the heavy lifting on this webinar today. We're very pleased to have all of you joining us. We think it's important to connect folks and talk about the the Tax Cut and Jobs Act that happened on the national level earlier this year. As you may have seen, we released a paper earlier in this month about what the Tax Cut and Jobs Acts will mean for Rhode Island. But we wanted to be able to make this information more accessible by also presenting it in a webinar format. We will be sharing both the recording of the webinar and the slides afterwards. And we really would be interested in hearing from you if you think there are other groups or folks who would be interested in accessing this information, because we really want to keep the conversation going about what this will all mean in the future. We know that what we are presenting today is just the tip of the iceberg in terms of what this will mean overall. And as taxpayer behavior changes, and also as the federal budget comes out, in which we expect that there will be large programmatic cuts, we think it's important to understand what this bill does and keep that conversation going. So a few housekeeping items. If you have technical problems, please call Juan Espinoza, who's our Communications and Outreach Associate. His number is 813-526-3043. We will have time built in for questions at certain points throughout the presentation. If you have questions, please type them into the chat box on the top right-hand corner. You are all muted, so we cannot hear you in person, but we welcome your questions and hope that you will type them in, and we will take time to answer them. And again, we will make the slides and the recording available afterwards if you missed something and need to follow up. So without further ado, I will turn it over to Doug to start the presentation.
Great, thank you, Rachel. And again, thank you to all of you who have taken time to join us this morning. I think Rachel's done a really good job of sort of queuing this up and setting it in context. Obviously, we're talking here today about the tax bill, but the implications of this for the budget down the road, of course, will also be significant. And we will touch on that, although I'm sure that once those budgets start to appear, we will do a much deeper dive on those. So Rachel's taking care of housekeeping. I want to throw out a couple of quick disclaimers. First of all, we are not tax advisors. The data that we have here today are aggregate data, and as they say, user experience may vary. Most of the things that we're looking at here, we are looking at clusters of income categories. For example, if you're a listener and you know that you're in that income category, what we say, it might apply to you directly, but there will obviously also be a fair amount of variance as well, since we're looking at averages in each of those groups as well. I think it's also important to recognize that there are still a lot of moving parts, many of which will depend on how people and businesses respond to the new tax laws, and you'll hear more about that as we work our way through. So I do want to first lay out a little bit of context, sort of the national picture of what we're talking about here. And I'm sure most of these pieces are ones that you might have heard before, but just recognizing that we're talking here about a $1.5 trillion tax cut, with the majority of that going to the very wealthy, as well as corporations here in the United States, but also significantly foreign investors. And so the pie chart that you see here actually highlights the fact that obviously the very wealthy folks, the richest 1%, and the next richest folks, they definitely get the biggest tax relief from this package. Interestingly, foreign investors who you see over here, their total tax relief, or the amount of money that they put in their pockets as a result of this tax act, is greater than what we see for the bottom 60% of United States filers. So I think that's pretty important and noteworthy, and something that we should keep in mind as we're analyzing what this means down the road. I think it's also important to recognize, and certainly in the context of the current administration, it feels sometimes like we're dealing with extreme situations, but I think it's important to acknowledge that the basic parameters of the Tax Cuts and Jobs Act, as well as the budget proposals that we've been seeing that are clearly linked and in somewhat in response to this, the Tax Cuts and Jobs Act, the groundwork of this is not something that's new to this administration. We've seen from Paul Ryan in particular, several budget proposals in recent years, sort of in response to the proposals or to the budgets that have been released by the Obama administration. The general sense of which is very much, you know, we're doing things to elevate wealthy folks. There may be implications for folks who are less well off, and whether or not there's significant attention paid to things like the deficit seem to change a lot depending on whether they're looking at their own proposals or if they're critiquing, you know, the other side's proposal. I think it's also important to recognize, you know, as Rachel noted, the name of the act is the Tax Cuts and Jobs Act. I think the title itself is a little bit misleading, since for most Americans, the tax cuts are temporary. And the primary jobs impact from the act will, I think, result probably not so much from the specific components of the tax act, but rather from the macroeconomic impact of a $1.5 trillion cut, a lot of which will probably not be paid for. And we've certainly seen evidence of that in the early stages here. So, as I said, we don't expect to see the Trump-Ryan plan, you know, paid for fully through budget cuts. But what we do see are early signs that there are key elements of the federal safety net that I think are in jeopardy. We've already seen significant talk about, you know, cutting Medicare and Social Security. You'll often hear that described as, you know, Medicare and Social Security reform. Be very suspicious of that term reform. It's another way of saying cuts. And of course, then there's other programs like SNAP, food stamps, that we have seen very clearly in the target lines of folks who are looking to advance a budget that ties into this tax act. All right, so stepping back a little bit and looking more specifically at Rhode Island. Obviously, the question that most of us on this call today are interested in is, how does the Tax Cuts and Jobs Act affect Rhode Islanders? And what we see, of course, is that, you know, as is the national case, when you look at Rhode Island data, you see that almost half of the tax benefit that folks see initially, these are data for 2019, almost half of that, 47%, ends up in the pockets of the wealthiest 5% of Rhode Island families, while the bottom 60% of families sees just 14% of the total tax reduction. Translate that to dollars, and what we see is that the richest 1% of Rhode Island families will see their taxes reduced by about $43,000, while middle-income families, those in the middle, 20% of the population, see their taxes cut by about $700 annually, and folks in the bottom 20% will see a tax change of just $70. You know, that translates to less than $6 a month, so don't expect those folks to be doing a whole lot to stimulate the economy with their tax cuts. One of the things that we see as we look at this tax act is that the mechanisms through which different people benefit are different depending on your income. And so we see, for example, that for most Rhode Islanders, their initial benefit is primarily through changes to the personal income tax, specifically those changes affecting families and individuals. And we'll talk more about that later on. Whereas for the very wealthy in Rhode Island, their benefit is substantially from changes to the personal income tax, but also through their connection to pass-through entities and corporations. And we'll talk a little bit more about that as well. This is probably a good point to just step back and talk a little bit about what we mean by a pass-through entity. You know, essentially there are several different types of corporations. A lot of folks, when they hear corporations, they're thinking of C corporations, and those are corporations that are subject to the corporate income tax. Here in Rhode Island, that's the business corporations tax. But then there's all these other pass-through corporations, pass-through entities. These are corporate entities that pass their income through That can be passing it through to a limited liability partner. It can be passing it through to to a regular partnership. The different types of pass-through entities include LLCs, LLPs, partnerships, limited partnerships, and in those cases, they're passing it through and it's being taxed not as corporate income, but as personal income for the individuals for whom that income is being passed through. And so here you see that the very wealthy, they benefit not just from the provisions of the Act that affect them sort of more directly as family members and sort of through the regular mechanisms of changes to the personal exemption, changes to the standard deduction, those sorts of pieces. But for those folks, their primary benefit is through their as shareholders of corporations and as partners or investors in pass-through entities. And so here we see in this chart compares the impact in 2019 of the Act on the bottom 60% of families in yellow, contrasting that with the folks in the top 1%. And so you see these are average changes in taxes for families of these types. For the bottom 60%, almost all of the tax benefit that they receive is sort of through their basically through their personal income taxes, and again, due to the changes in the personal income tax structure. Now, because most of the data that we're dealing with, and this is another thing that I should have mentioned up front, most of the data that we have come to us from the Institute on Taxation and Economic Policy. They have a very sophisticated micro simulation model that lets them break out, not just looking at sort of who pays the tax up front, but actually breaks it down to determine sort of who ultimately pays a tax. So, for example, if it's a corporate tax, we know that corporations pass a significant share of their taxes onto their customers, for example. And so you do see very, very modest changes in taxation for regular folks in the bottom 60%, as a result of the changes to the taxes on pass-through businesses, and also changes on corporations. Contrast that with folks in the top 1%, and you see that while you see two things. First of all, you see that the changes in the personal income tax structure, affecting them as family members, they dwarf what's happening for folks at the bottom 60%. But then even more significantly is recognizing over here that the vast majority of their total impact, their total $43,000 plus in average savings, the vast majority of that is coming through their relationship to pass-through businesses and their relationship to corporations as shareholders, et cetera. And I think, were we pausing there to see if there were questions?
Yes, we were going to pause here because I know that was a lot to digest. So if there are any questions, please type them into your question box. If you don't have any at this time, we will pause after the SALT section to answer more questions. So I think, Doug, you're safe to continue.
Okay, great. So we did want to give people, a closer look at the personal income tax changes, and these are, pretty significant changes on many fronts. And what we're anticipating, to sort of steal the punchline here, is that the ways in which people file their taxes, some of those dimensions will change significantly as a result of this tax act. So first of all, you see pretty significant changes in the tax rates. So over here we have the tax rates and brackets that existed prior to the act, and on the right-hand side we see the new rates and brackets under the Tax Cuts and Jobs Act. And so you see a reduction in the tax rates in pretty much every category down the road there, except at this sort of second last spot. But then you also see, and it's a little hard to sort of visualize, but essentially the ranges, the brackets themselves, have changed also, especially in this sort of middle to upper range. And so as a result of that, those are sort of the main pieces that are going to affect the rates at which people are paying their taxes. But then there's other components that I think you'll find will end up having at least as much of an impact, if not more so. And importantly, each of these pieces are pieces that are currently due to expire as of 2026. And so by the time you get to 2027, you'll see some comparisons in data down the road. The picture is very different than it is at the front end of this process. So the standard deduction in the Act, it's nearly doubled from $13,000 to $24,000 for married filing jointly families, and from $6,500 to $12,000 for single filers. That's a really important piece of this puzzle. The other thing we see is that the personal exemption at the federal level, the value of the personal exemption, which had previously been set at about $4,000 per person for 2018, the value of that has now been set to zero, effectively eliminating it, although there's sort of an asterisk on that, and we'll get back to that in a second. But essentially, the fact that the personal exemption, they haven't eliminated it, it still exists, it just exists with the $0 value. That'll matter down the road when we talk a little bit about what this all means for Rhode Island at the state level. So for Rhode Island families, another significant change is that the child tax credit, has been increased to $2,000 for each child from $1,000, and taxpayers are newly able to claim a $500 credit for each non-child dependent. So if you're taking care of an elderly parent or something like that, or a disabled person, you can claim that for them as well. All right, so for homeowners, there's some significant changes here as well, although you'll see in the dollar figures here that these are mostly changes that are going to affect, people who are generally much wealthier, although you'll also recognize that these changes will affect, communities, cities and towns in which you have a significant share of people who might be owning homes that are very highly valued like this. So, for example, the Act caps the value of mortgages at $750,000, down from the previous limit of $1 million, in terms of sort of how much of that interest you can charge, or you can claim, sorry. The Act also eliminates the tax deductibility of home equity loans. So for, middle-income folks who aren't looking to buy a new home, they're not looking to buy a second home, they just want to fix up their existing home, you can no longer claim as a home equity loan. You can't claim that as a tax deductible expense. However, it also retains, subject again to the $750,000 cap, the tax deductibility of second homes. So obviously that benefits folks who are wealthy enough to be able to afford second homes. So that's significant. And then this final piece, state and local tax deductions. What's really significant about this is that it's received a lot of attention, more on that in a second. But basically, the change here is that the Act limits the amount of state and local taxes that are deductible on your federal income tax to a combination of $10,000 for income tax, sales tax, property taxes. More on that momentarily. Just to give you a sense of the ways in which this impacts folks, currently, or should I say prior to the Tax Cuts and Jobs Act, about a third of Rhode Island filers, and nearly all filers with incomes above, let's say, $100,000, they claim the itemized deductions. And so for folks who are claiming itemized deductions, the things that impact itemized deductions that we just talked about, those are pieces of the puzzle that will matter a great deal. However, for folks in lower income ranges, you'll see that it's going to have much less of an impact on them. And so just to give you a sense of what the components of Rhode Island's itemized deductions look like, you'll see here in this pie graph, the two big pieces are state income taxes and real estate taxes, so your local property taxes essentially. Those are the big pieces of the state and local tax components. And then we also have in Rhode Island the motor vehicle tax, and unfortunately that's buried in the data here in this other category. I think it's probably a relatively small share of that. But it is important to recognize that that's another piece that people will be looking at as they determine whether or not they're going to continue to itemize their deductions as perhaps they had been in the past, or whether instead they will be opting to go with the significantly increased standard deduction. All right, so as we noted, the SALT deduction, the state and local tax deduction, is one of the largest components of Rhode Islanders' standard itemized deductions, accounting for about a quarter of that in total. So again, that's state income tax, local real estate tax, local motor vehicle tax. Limiting this SALT deduction in combination with nearly double the standard deduction will result in a substantial share, and we admittedly don't know what that share will look like, of folks who will shift from itemizing their deductions to using the standard deduction. There are some folks who are concerned that this will result in perhaps a reduction in people giving charitable deductions or charitable contributions, to various nonprofits, et cetera. I think this falls very clearly in the category of changes that we really won't know what that looks like until we see sort of how people's behavior changes. And my sense is that for nonprofit organizations, you're probably going to continue to see, the folks that have been supporting you in the past will continue to write you checks. Whether they end up writing you smaller checks, that will depend, I'm sure, on a case-to-case basis. Let's hope that's not the case. And if anything, it's entirely possible that all the sort of media attention about how nonprofits might be under siege as a result of this might result in people paying more. We can hope. I think it's important, though, to recognize that for the wealthier folks out there, the fact that they're not going to be able to claim the state and local tax deduction at those higher levels needs to be looked at in a broader context. And so we see that in this chart here. And what this is looking at is the impact of federal tax cuts on incomes of folks over $1 million. And what we see here is that, and these are Rhode Island specific data, as a result of tax increases from the SALT provisions, those folks are going to be paying $45,600 more in taxes. But what we see is that the other tax changes that are part of this package result in changes of about $105,000 taxes less. And so you put those two pieces together and you see that for millionaires in Rhode Island, you're looking at tax savings of over $59,000. So we think that's pretty significant. There has been a fair amount of talk, and we'll get to this in a few minutes, but there are some jurisdictions that have been looking at the SALT changes and trying to find workarounds. We see a little bit of that in Rhode Island, but I think the truth is that it's very unlikely we'll go very far down that road. I think that the changes that we've seen in the tax structure, once those sort of play out in terms of changed regulations from the IRS, some of the back doors that people are exploring right now are ones that will no longer be available. All right, so shifting now to talk a little bit about the impact of the Tax Act on Rhode Island businesses. C corporations will see a permanent reduction in the federal corporate income tax from 35% to 21%. And that's a pretty dramatic change. Pass-through entities, again, those LLCs, LLPs, partnerships, et cetera, their tax change will be to reduce they get a 20% deduction on their qualified business income. So for each business entity, corporation, whatever you want to call them right now, they will be looking at these two pieces of the puzzle, and you can assume that they will be working with their tax advisors to make sure that they're paying, the smaller amount of tax that's available to them. And so what we expect to see is that there will be some folks who will shift from currently being a C corporation to being a pass-through entity, or vice versa. My suspicion is that there will be more of the people that are deciding to become C corporations, although whether they do that now or closer to the end of the process or closer to 2026, when some of these provisions phase out, again, that will be determined on a case-to-case basis, but will be determined in a way that benefits those corporate entities. it's also important to recognize that when you start to sort of look at the nitty gritty, the fact that that pass-through entities get a temporary 20% deduction on qualified business income, that qualified business income piece of that phrase is really important. And in terms of how the restrictions on that income are played out, again, we'll see how that goes in terms of how people are paying their taxes, how companies are paying their taxes. But I think it's important to recognize that that will end up being a significant limitation for Rhode Island businesses that are currently set up as pass-through entities. Just taking a quick look at how the Rhode Island's personal income tax is affected in terms of the impact at the state level. So, for state officials that are paying close attention to this, what's this going to mean for revenues in Rhode Island? It's true that several states are looking at a very different situation. And in Rhode Island, what we see is that we're one of 29 states that use federal adjusted gross income, AGI, as the starting point for determining state income tax. And so the changes that happen after that on the federal tax form, changes to the personal exemption, changes to the standard deduction, those are pieces that don't affect what Rhode Island's personal income tax ends up looking like. And so, again, the disclaimer here is that, personal income tax is largely unaffected sort of initially, but that will depend in part on whether or not Rhode Island corporations shift either to or from, C corporation status. So again, pass-through entities are entities that they pass their income through to be paid as personal income. If suddenly they're not passing that through as personal income, but instead have redesignated themselves as C corporations, you will see a shift in Rhode Island's revenues from the personal income tax line, to the corporation tax line. And whether those end up being offsetting completely, I think it's too early really to know how that will play out. All right, and again, that's essentially what I'm saying here. The impact on corporate income taxes will depend on how those corporations respond to the new rules that are in place. And in fact, probably the bigger impact for Rhode Island state officials will occur when we see the cuts that sort of accompany the other shoe dropping. Essentially, we know that this is a pretty significant tax cutting package. We also know that the administration that has proceeded with this tax cut package has also historically wanted to restructure fairly significantly things like the safety net, things like our so-called entitlement programs. And so as some of those pieces of the puzzle shift over time, we may see Rhode Island needing to step up to fill some holes that had previously been filled through federal programs and services. I think, again, this is one of those things where we'll just have to play a little bit of a wait and see game, but I think it needs to be a wait and see game where we realize right now that we're going to have some significant fights on our hands to protect the programs and services that help Rhode Island families thrive. So one thing that I had mentioned is that by 2027, a lot of the provisions of the Tax Act will have phased out. Now, some people will say, well, that's way down in the future, and what if there's a change in government? And all of those things are entirely rational and reasonable things to say. But the fact remains that in terms of the law of the land at this point in time, there's several provisions that are scheduled to phase out. And so this chart looks at how those changes affect the components of the Tax Act that specifically affect families and individuals, the components addressing pass-through businesses, and the components addressing corporations. And what you see, and again, this is because the tax rate, primarily because the tax rate for corporations, is permanent into the future. The picture that they see in 2027 is not dramatically different than what we see in 2019. When instead you compare for both pass-through businesses and for families and individuals, we see a shift, a pretty dramatic shift there from folks doing very well by way of this tax act to suddenly paying not the same as they would have paid regardless of this act, but instead more. And so, this is the aggregate impact. Obviously, the changes, will be distributed, differently throughout the income spectrum. But the bottom line is, again, for folks that are looking at this as a tax cutting act, which you might mistakenly do given the title, we see that down the road, this tax cutting act actually increases taxes on Rhode Island families, as well as on pass-through businesses, which are disproportionately smaller businesses. So that is our quick overview, and as has been suggested, we are very welcome of your questions at this time. We would appreciate any feedback that you can give us, either on this presentation, on the specific provisions of the Act itself, or really anything that helps us to do a better job of trying to make sure that Rhode Island's tax structure is being appropriately responsive to the federal context.
Thanks, Doug. So at this point, we have a quiet crowd. We don't have any questions in the queue. So let me ask you one to get folks started. I know that there have been some legislative proposals introduced. Can you talk a little bit about what we're seeing on those in terms of trying to address some of these federal tax changes?
Yeah, so one of the mechanisms that has been suggested for essentially getting around the SALT limitations, there's basically two mechanisms. One is to create essentially a charitable entity to which people can make a contribution sort of in lieu of their taxes that would then be sort of manifest itself as a tax credit. And that's actually the mechanism that we see being proposed here in Rhode Island. There's actually a bill in both the Senate and the House that's been proposed by Senator Pearson and Representative Marshall. Those are bills, Senate Bill S2216 and House 7550. And what those bills essentially do is they create what they're calling the Rhode Island Ocean State Fund. And essentially, again, the mechanism here is that people could make some contribution to this fund and essentially see a reduction in their, basically it becomes a tax credit towards their Rhode Island taxes. So it's essentially a way of reducing the amount of state and local taxes that people are paying, and therefore reducing the impact of the capping of the state and local deductions on those folks. Now, my sense is that this probably makes better politics than it does fiscal policy. And so I think, our general approach is to say, looking at this as sort of as an entire package is probably a more prudent way to look at it. And recognizing that for the vast majority of people who might have this sort of visceral reaction to, oh my God, you're taking away my state and local tax deductions, we think that most of those people are going to be shifting over to claiming the standard deduction anyway as a result of the more or less doubling of that standard deduction. So, whether or not that mechanism makes sense down the road, I think it's questionable. And again, my sense is that there will be some IRS response to some of these ways that various entities, various jurisdictions are looking at to avoid the impact of the SALT deduction cap.
Great, thank you. We have one question in the queue. I get that wealthy folks will be getting a bigger tax break than hike, but will the SALT increase feel more immediate or be more obvious than the tax breaks they are getting?
Again, my sense is that probably for the folks that George is concerned about, they're going to see that it's more advantageous for them to claim the significantly larger standard deduction. Whether or not they feel that that's an option that they're less comfortable with than sort of the status quo, that's really tough to tell. And to me, I think it probably highlights sort of it almost highlights the initial disclaimer that the specifics of how this plays out for any particular family, are going to vary. I think that one of the things that we may see over time is that people might end up feeling a little bit differently about their state and local taxes, which obviously is not a situation that that we want to encourage. So it's definitely it's a challenging aspect of this tax act. But my sense is that sort of keeping the big picture in mind and recognizing that, at its base, this is an act that very much helps, the very wealthy, both initially and in the long run. And the fact that the part that lower income folks should be more concerned about, low and middle income folks, is the fact that the provisions, some of the provisions that actually will make their tax situation better, are the ones that are scheduled to phase out over time. So, obviously to me, the play at this point is to figure out how to, make some judicious changes to the current law of the land that will make the federal tax code more amenable to the well-being of low and middle income Rhode Islanders.
Great, and we have another question. You mentioned being proactive in preparing for the other shoe or future budget cuts. In your opinion, what are some of the specific steps Rhode Island should be taking to prepare for this?
Well, certainly one thing that we think is that, we know from budget talks that Rhode Island has been looking at, excuse me, some structural deficits down the road. And, we also know that to address some of those deficit situations, we've already seen some fairly significant cuts, here in Rhode Island. And we want to make sure that Rhode Island is in a situation where they have the necessary resources to respond appropriately. So, my sense is that this would probably be a good time for Rhode Island to think about, what revenue options might be available out there, so that we can, so that we have the resources that are necessary to continue to invest in, in a state, so that our families can prosper, our communities can be strong, our schools can be, safe and structurally sound, and all those things that are the things that make Rhode Island's quality of life something to be envied.
Another thing, Doug, that might be worth mentioning is that one of the provisions that you haven't talked a lot about, but that is included in this, is the changing in how the EITC is calculated going forward. The inflation adjuster will be altered, so the value of the earned income tax credit going forward will actually be decreased. So one of the things that we're talking about here also is continuing to push for an increased state earned income tax credit, or higher state earned income tax credit, as a way of balancing that eventual depreciation of the federal credit.
Yeah, I think that's a really important point. And it also, to me, highlights, one aspect of really this, but really any tax act, which is that there's a lot of sort of pieces of the puzzle that are kind of wonky and don't necessarily seem that significant to folks up front. The difference that you're referring to is shifting to the quote unquote chain CPI. And essentially what that does is that over time, it means that the inflation rate that is applied to the earned income tax credit, it ends up being smaller, and the impact in year 1 or year 2 is not particularly significant. But by the time you get 10 years out, 15 years out, it ends up being real money. And of course, we're talking here about the very people who are least able to, to shoulder a reduction in their income as a result of detrimental changes to the earned income tax credit. And certainly your point is well taken that Rhode Island can increase our EITC in response to that. I think one of the reasons that we might be absolutely want to do that is that because our earned income tax credit is explicitly tied to the federal EITC, not only will the federal EITC shrink over time as a result of the changes, but the Rhode Island one will as well. And so, all the more reason to make sure that we are making the changes necessary to hold Rhode Islanders harmless.
Great. Well, we don't have any other questions in the queue. So I want to just say again that we appreciate all of you joining the webinar today, and we are very interested in hearing whether you found this helpful. We would like to be able to do more of these webinars if they're helpful for folks. And, you know, as we said, this is just the beginning of understanding what this Tax Cut and Jobs Act will mean for Rhode Island and what it will mean in terms of all of us being able to keep our community strong and thriving. So we hope that you'll let us know what you thought, let us know how we can improve, and continue the conversation of how we can work together to have a stronger Rhode Island. Thank you very much.
Thanks all.